stock is under your 200, your bias has to lean toward downside because once you're under your 200, the overall trend of that stock is bearish. So even though it's pushing up, when you're under your 200, unless you have something to give you an early reversal signal, this is not the time to like be hammering long calls unless you're at like a critical support level or like a demand zone or something like that. But other than that, when you're trading, especially if you're day trading, you want to favor puts when you're under the 200 and favor calls when you're above it. So we'll look at that on like a smaller time frame, like the 15-minute, and you'll see it's the same. What is that? It's the same type of scenario, right? So when you're above your 200, even on the smaller time frames, you want to hold on right quick, refresh this. So everything I'm showing you now with the higher time frame, it applies to every other time frame. Okay.
Mm-hmm.
All right. Let's see. Let's save that. Let's go back to the spot. Okay, I knew I had heard somebody else on the call, so that's Joel. Yeah, I pronounced your name right.
Yeah, Joel.
Joel. Okay, I got you.
I apologize. I couldn't find the Zoom link. And
No, you good. You good. You good. All right, so this 200, the 12, and let's add the 200 back to the chart. So when they work together, so we're using these two moving averages to help us see what the short term trend is, the short to mid term trend, and then also what the overall trend is, because this is the whole purpose of these moving averages. So they do two different things primarily. The first is you want to see, they show you what the trend of the stock is. So the 12 is showing us a short term trend, so we can see quicker trend shifts. And the 200 is showing us what the overall trend of the stock is. The other purpose of these moving averages is that they act as what we call dynamic support and resistance. So you see how we're pulling back with the 12 flip to red, even though we're above, our overall trend is bullish on the SPY, right? So if we zoom out on SPY, we can see that if you would have been focusing on puts the whole time on SPY, you made a little bit of money right here. You made a little bit of money right here. You made a little bit of money right here. But the people that respected the 200 and realized, okay, the SPY is predominantly over the 200, they've been making most of the money because the bigger moves have been to the upside, because you can see with this bright yellow 200 that the SPY is ultimately in the uptrend, right? So these little pullbacks have been by the dip moments. And we can see that when we talk about dynamic support, just like you have horizontal support, like if I put this line on this chart and drew it right here, right? If I put this line on the chart as a support line, this is how a support line or a resistance line would look if you were rejecting or bouncing. But the moving averages act as dynamic support. So they're like moving support and resistance. So you can see how when these stock candles come back down to the 12 EMA, they're tapping it and bouncing off of it, bouncing off of it, bouncing. So it's acting as support. And then when it breaks under it, when the stock tries to get back above the 12, you see how it's acting as a resistance level as well. Same thing with the 200. It's coming down and it's bouncing off of this 200, shooting back up, bouncing off of the 12. So it's acting as dynamic support. So these are two purposes that we use our moving averages for. And we see the same thing when we're in a bear trend. If you were, once the spot got under, this was back in January 2022 through 2023 when the market was dumping. If you were fighting just trying to buy every dip and go long, you will get faked out. It popped up and then it dropped back down. Popped up and then it dropped even lower. Because when you're in the downtrend, we're just doing we stair stepping down, right? Making what they call a higher low and then a lower low, a higher low, then a lower low. We're just making this downtrend, right? So most of the money, even though you did make some money on these little pop ups, like right here, you popped up a few hundred, a little bit on spot, but you getting these big giant drops. So ultimately, if you would have stayed in puts, you'd have made more money, right? So when we're under our 200, that shows us we're in a bear trend, and above it, we're in the uptrend. The other thing you want to make sure of as well is that it's not really about the candles peaking their head above the longer moving average. So we look at the 200, since it's looking at 200 candles as the longer trend moving average. What you want to see is you want to see your 12 EMA get above that 200 and just hold, right? Because like right here, for example, when we pushed up, and when a 12 EMA is under the 200, it's not good enough for stock candles to get up here and shoot up here and seem like they're going to pop up. Just like you saw it again here, we got candles getting above the 200. But you mainly want to see it when a trend is reversing from a downtrend. You want to see the 12 EMA get fully above and hold above the 200, right? So just like right here, you see how once the 12 got over the 200 and got a little height above it, you see how that was a sustainable uptrend shift, right? And so that's what we look for with these two moving averages. We want to make sure that we're using the 200 to show us the overall trend and the 12 EMA to show us the short term trend. The third moving average that we have on the chart is the Wolftrend moving average. Okay. And that's this green line right here. So this moving average is a faster moving average. I created this moving average, or I coded it. So it's only on the Wolf chart. But I built this moving average to work in partnership. It works with the 12 EMA, but it mainly works with our smart money buy zones and sell zones. So if we turn these on the spy, I'm gonna show you how this moving average operates and what its true purpose is. So this moving average is quicker than any traditional moving average, and it's more intelligent than regular moving averages. So the reason why I say it's more intelligent is because the code that I put in it allows it to know where smart money investors, when they come in with high volume, it rushes down to where the buy zone is and then confirms the early entry. So whether we're under the 200 or above it, it'll still give you that early reversal signal whether the stock is going to pull back or whether it's going to go up. And so if you look at it so we look at Tesla, for example. I think I traded Tesla, and we got a decent reversal on them from the supply zone. But you see how when Tesla was in this strong uptrend, once the candles open and close under this green moving average, so this red one, so this green moving average is the Wolf Trend moving average. So you will see me call it the Wolf Trend moving average, the WTMA, which stands for Wolf Trend moving average. But the reason I built this moving average initially, when I first built it, it didn't have this red line attached to it. So the moving average actually is two lines. Okay. So the moving average is this green line here, and it makes this is it moves very smooth, but it makes like this arcing shape. So that's why I named the confirmation the arc confirmation. And for calls, I named it the inverse arc. So what it does is, since it can sense where the smart money is and these supply zones and demand zones are, and I also put the ATR code inside of it, so it knows the average range that each candle on whatever time frame you're on can move. And so it has noise filtering and a bunch of things inside of it to help us to get in and out of trades. And so the confirmation works like this: we're looking for a candle to open, like for puts, we want a candle to open under it with the wick and the body of the candle not touching this green line, and then it'll arc over it and come down. Now, the reason why I built this other part of the moving average is because with options, it's all about timing. So we don't want to get into puts here just because we got an open and close candle. It pushed down and it shot back up, and then it ended up dropping, right? But these are daily candles. So we want to kind of enter into a trade and then get the timing down. So what I did is so it's a thing called the MACD inside of trading, and it has a signal line cross. And all that means is it's just an indicator that shows you when the momentum is shifting and when to enter the trade. Well, the way I built this moving average is it's a lot faster than a MACD, and it's like very, very accurate. So you can see now with this, when the green line crosses under this red signal line, that's our confirmation to enter. And you can see by once we get this crossover, it's timing when the actual volatility is ready for us to drop. So now we can, so with options, since we have time decay, it's very important that we can actually time our entries correct